Hi everyone, I'm Aura Ogorian with ACAP Advisors and Accountants, and welcome to another series of educational series where we talk to an expert in a certain area. And today we're going to talk to Bahram Amakanyan. Did I say that right?
Amayakian, yeah.
Amayakian. I'm sorry, and as if my last name was any easier, Bahram. So today we have the pleasure of having Bahram with us, and he's going to talk to us about mortgages because buying a home is probably the largest purchase that people make in their lives, and it's an important one. And many times people only do this a couple of times throughout their lifetime, and they need some really good guidance when they're making these major decisions. And Bahram is an expert in this area. He understands how to navigate the mortgage arena, how to get people the mortgages and the type of mortgages they need to help them qualify for buying this large purchase. So Bahram, thank you very much for joining us today. Why don't you tell us a little bit about yourself, a little background, and then we'll dive right into the presentation.
Yep, thanks for having me, Ana. Great to be on this webinar, everyone. Again, my name is Varam Amayakian. I'm with Wintrust Mortgage. Wintrust is a direct lender, FDIC insured bank, headquarters in Chicago, but it has a footprint here in the Southern California area. We lend in all 50 states. As far as my expertise, I've been in the mortgage business since 2002. So kind of went through the crazy times, wild west, as I like to call it, in the early 2000s, and then made it through the mortgage meltdown in 08, 09, and then we're here at the post COVID, and some interesting changes have obviously taken place in the last 6 to 7 months. So excited to talk to you guys about the mortgage process. There's some good takeaways here with this webinar. So if we could just jump right in, if we can go to the agenda page, the next screen, kind of tell you kind of what we're going to cover today, and go from there.
That sounds great. Well, you're clearly a veteran in this area, so I look forward to hearing what you have to say. And just let me know when you want me to move on to the next slide.
Understood. Okay. Thank you. So obviously, the agenda, a couple of points here, right? We're going to look at the mortgage process. A lot of first-time buyers out there, the questions that they have, what documents are needed. Some people are very, green to this process, and then you also have those people that haven't needed a mortgage or haven't applied for a loan for a long time. Things obviously have changed drastically the last, as I mentioned, from 08, 09 to today, the landscape's completely different. So we'll talk about the process. We'll go into the key features in purchasing a property. We'll touch on the different types of mortgages, different types of loans that could help and then a buyer achieve the dream of home ownership. Also, some of the pitfalls, right? Things to avoid when you're applying for a home loan. We'll get into that. There's some things that people just don't think about avoiding and not doing that could definitely hinder their ability to close on a transaction. So we'll touch on that a little bit, and then the last couple slides we'll talk about different options for the non-traditional borrower, right? Somebody that's self-employed, has unique tax returns, or files unique tax returns. Those folks have options, that could help them, purchase as well. So we'll look at that too. So if we can go to the next slide,
Yeah, before we go to the next slide, I think the last bullet point here, when we get to that part of the presentation, will be very helpful because at least we have a lot of clients who are business owners and they fall into that category. And I know there's a lot of people out there who are self-employed, and it's very challenging for them to fall into that neat box that a lot of banks are hoping for them to fall into. So it'd be great to kind of hear your thoughts on what those types of borrowers could do to make themselves more competitive in this landscape.
Very true. So just a quick recap on the process. It could be, we broke it down into kind of 5 stages here. So the premier borrower process, that's basically another term for just the pre-approval the initial review of the documentation. What people do these days, which is not correct, is they go out shopping for a property, fall in love with the home, and then they come back and talk to, a mortgage professional and go through the paperwork, and then they find out, oops, this isn't something that I could afford. Their hopes and dreams are crushed. So always, always, the number one thing you need to do, any buyer needs to do out there in this landscape, is just get pre-approved, start that process, start the loan application process, right? So go through the pre-approval, fill out that application. The third thing here is really interesting, locking in an interest rate. I get this question asked all the time, going through the initial review, the pre-approval, quoting rates, and then you'll have a customer say, hey, let's lock in that interest rate. And that's a big, a misnomer. The only time a lender can lock in an interest rate is when a buyer and seller have agreed and are under contract on a property. So there's a property identified, right? There's a length of time of the escrow. That's the only time that an interest rate can be locked. It cannot be locked during the initial pre-approval. Only be locked when you're under contract. You don't have to lock right away, but the first, available time that somebody could lock in a rate is when they have an agreed upon purchase price. Now, if you're refinancing, you already own the property. If the rates come into view, you could lock at any time.
I got a question regarding that, Bahram. What happens if you lock in a rate and then rates go lower? Can you, go in on a lower rate? Is that possible?
Good question. So when a lender commits to a borrower and it commits to an interest rate, they're doing so with good faith that even if rates get worse, they're committed to that interest rate that the borrower chose to lock on. When it comes to it's called the price renegotiation. So if interest rates improve, and this varies from lender to lender, right? There's got to be a substantial improvement in rate and fee for a lender to break the lock and relock at a lower rate. Have we done it before? Has there been a climate, a time that you've seen rate improvements where a buyer has kind of broken the lock and renegotiated the terms? Yes. Is it completely free? No. There's some fees involved to break in the lock, but very minimal compared to obviously the savings the borrower is going to see long term. So did I answer your question?
Yeah, that answers my question. Yeah.
So then obviously the next part is the actual approval of the financials. So we gather all the information on the next slides. We'll talk about what documents are needed, but all the paperwork's gathered. It's presented to a bank underwriter who will underwrite and formally approve the loan. And then at that point, kind of the loan officer and the borrower will work together to meet conditions. And then obviously the last piece of the puzzle here, just is closing, right? It's just the last piece of the process here. So any questions on that, or should we move on to
yeah, let's move on to the next slide. And
yeah. So questions, obviously first time buyers, what documentation is needed, is what documentation is typically needed to find out one's ability or pre-approval ability. So let's just touch on these a little bit, right? So these are just kind of standard documentation that's needed. Obviously 2 years of tax returns and W-2s. Just the important thing on there, if you could see next to the word returns, we need all schedules of the tax return. Sometimes borrowers have business interests, that show up on a Schedule E of a tax return. They may have a side business that maybe doesn't make any money. It's just a hobby for them that shows up on a Schedule C of a tax return. That's why the first page is, everybody says, hey, can I just send you the first page? And the answer is no, because we really want to take a look at what what's on the schedules, right? There might be Schedule B, interest income, dividend income. That's definitely, that can be used to qualify. So always need all pages of the return, and then obviously the federal return only. We do not need, a lender doesn't need the state specific returns when it comes to the tax returns. Obviously, 2 months bank statements. Again, keyword all pages. This comes up all the time. You'll have a borrower who will send you the first page of a bank statement. The lender's looking for the activity over a 30-day period, and the reason they're doing that is they want to make sure, you know, that there aren't any large deposits into someone's bank account. Mainly people, there's some people that have cash, right? They're sitting on cash and they'll deposit cash into a bank statement, into their bank account. Then it'll end up with a healthier balance at the end. But anything that's non-payroll related, any large deposits, those are scrutinized and reviewed by a bank underwriter. So you want to get ahead of this in the beginning of the transaction, right? During the pre-approval period. So, you know, we address those questions if they're there, if there are any large deposits. So all pages of the return, all pages of the bank statements. Obviously, pay stubs, right? Most recent pay stubs. And this is important because sometimes people will have, you know, they'll have changes in pay, raises, you know, you'll have, you know, things change that are different from a previous year's W-2 or a tax return. So the pay stubs are important. And then the last one on here, obviously, if you are an individual who has business interests, you know, a bank would need to review those tax returns, and this is key. The business tax returns are needed if your ownership interest in the business is greater than I believe 25%. So if your interest is less than that, then the K-1s would be sufficient.
Okay, I've got a couple of questions related to this. Earlier, you mentioned dividend income, you know, including that as part of the income qualification.
Sure.
Is the dividend income discounted in any way, or do you just consider that as regular income that a person receives?
It's when it comes to dividend income or interest income, that is averaged out over the last 2 years. So we look at what you've filed on a return for, you know, 2021, 2020, and it's averaged out.
Okay, but there's no discount taken. So if the average is $20,000 a year or $50,000 a year, you'll include that just as if it was regular W-2 income, right?
Yeah. Here's the thing: if 2020 had a higher dividend interest and 2021 was substantially less, you cannot average it. Similarly, when it comes to, or if we're talking about income, let's say you have an individual who has a set salary, but also earns overtime.
Yeah.
So the overtime and ancillary pay on one's income documentation, it's a 2-year look back on every scenario. It's a 2-year look back. So if somebody, because this is ancillary pay, it's above and beyond what your guaranteed pay is. So
right.
If you have that had just worked more OT in 2021, and there was a substantial decline in 2022, the lender will always take the most conservative approach, and they will do a 12-month average of the ancillary pay. Now, if there's a slight difference, I mean, we're talking 5%, 7% difference in this ancillary pay year over year, they'll average it. The only instance is if there's a substantial decline in the, you know, overtime pay or this dividend income, if it drops completely, you know, they're going to take a more conservative approach.
So on that same note, for someone who's contributing to retirement accounts, how do you factor that in? Let's assume they make $100,000 of income, but they shelter $50,000 into a retirement account, do you look at the 50,000 net amount as income available for loan servicing, or do you look at the entire 100,000 because the 50,000 is basically their option of putting the money in?
Good question. Yeah. So if somebody's salaried making 100 grand a year and he's contributing to a retirement account, I take the base salary. I do not look at. Similarly, obviously you pay, your W-2, you're salaried, you pay taxes. I don't qualify you on the net income after you pay taxes. It's on the gross.
Okay, because the gross income won't show up on the tax return. On a tax return, you see what's on box 1 of the W-2, but that's already factored in.
Correct.
The 401k contribution.
That's why you look at pay stubs, Ada, because the pay stubs will tell you the frequency of pay. Some pay stubs will have the actual salary on there. Okay. This is all validated with, once you're in escrow, you're going through underwriting. All of this information is vetted through a verification of employment process. So you'll have a processing department that'll reach out to the employer and just to verify all of the documentation, starting with position, again, frequency of pay, start date, so on and so forth. So all of that's vetted. But to answer your question, we use the salary, the guaranteed salary, not the line 1 of the tax return.
Okay, perfect. Should we move on to the next slide?
Yep. So key factors in purchasing a home. Again, I kind of broke this down into five factors. The number one component of qualifying, obviously employment, job stability, income. That's the number one component in this market and qualifying for a loan is your ability to repay this mortgage. The credit score, credit history will, obviously, the second most important piece of this process. Assets, there's several programs available today that does not require a 20% down payment. There's programs and there's options with, in some instances as little as 3% of the purchase price to purchase a property. And just to comment further on assets, if you're a first-time buyer, your down payment, your entire down payment could be a gift from a family member. So assets are probably the least important part. They're important, don't get me wrong, but not as important as the job stability, the income, piece, and the debts below, the fourth point there. And then the home qualification is the property itself, right? Is the property financeable? Is the property habitable? You'll have, people look at homes that, they're just in horrible shape. It's not livable. A lender will not lend on it. It's more of an investor that will pay cash for a property and then just turn around and rehab it and sell it. So the property, the evaluation, obviously, is a key component too of this process. So
that's a good point.
Yeah, those are the things we'll touch on here a little more in detail.
Okay. Next slide.
Let's do that. So job stability, right? I'm just going to read through these and then I'll have some comments, right? Some of the concerns or the key components that we look at is job history. Is it less than 2 years? The 2 years the number 2 is a key number in this industry. As I mentioned in the previous slide, looking at a 2-year average, if you have, dividend income or ancillary income, have you, same goes with job history. Have you been on the job X number of years? There's some instances that's not important. I'll comment on it in a minute here, but that's important. People that have multiple jobs, right? You need a 2-year history. So if I have my main job, I have a side job, and I want to use that second job, the income from that job to qualify for a purchase, I need to provide 2 years of history of having both jobs in order to in order to use that income from that other job to qualify, right? Multiple job changes, income instability, employment gaps. These are all things that we look at. Income stability or instability, that kind of goes back to what we talked about earlier, is the if somebody's on commission based, right? If you're a commission based employee who's
Right.
W-2'd, and there's several of them out there, how stable was that income, that commission income, the last 2 years? Is it ebbing? Is it flowing? These are the things an underwriter looks at, a bank looks at when determining the final income, to help qualify or justify the mortgage.
Right. Should we move on to the next slide, next factor?
Yep. Credit history. Let's talk about this a little bit. I got some thoughts on this. So what is a credit score, right? A credit score is a number assigned. There's three credit reporting agencies. You got Equifax, TransUnion, and Experian. The credit scores, you can see they range from anywhere from 300 to 850. When we pull credit on a client, we pull a tri-merge credit report. So you'll pull all three credit bureaus. And here's the thing, right? Each bureau is going to have its own kind of credit score and rating. What's important is, you'll have a customer say, hey, I checked my Discover credit card and I have my FICO score says it's X. And they're giving them one score. They say, I have a 720 credit score. Well, that's really good. That's, that's a decent enough of a credit score. But when it comes to our end of the table, we do the tri-merge credit pull because we do not care about, the lender doesn't care about your high credit score. They don't care about your low credit score. They want to look at what that mid credit score is. So, and that's the credit score that's used to, underwrite the loan, price the loan for, interest rate, locks, etc. And another thing with credit, if you have multiple borrowers on a credit application, so you got a husband and a wife that are applying together, right? And we pull a credit report on both. Understand that when there's multiple borrowers on an application, the lender will use the lowest middle credit score from both borrowers.
Wow.
when determining again, qualification, interest rate, locks, etc. So if you have a husband and wife, and let's say the husband has a 680 FICO score, mid credit score, and then wife's credit score is 740.
Yeah.
You can't just use the 740. You have to take the lowest of the two, which would be the husband score in this example that I'm giving.
Has that always been the case, or have banks just become like super conservative in their underwriting doing this?
Ever since I've been doing it, that's always been the case.
Interesting. All right.
Yeah. So there's some instances where you'll have, a couple qualify or apply together, excuse me, and we'll have this happen. It happens probably, I don't know, 3 times out of 10 from experience. And sometimes you'll be fortunate enough where that individual that has the higher FICO score has the ability to qualify for the mortgage on his own or her own. So that's where we have a dialogue with the borrower. This is during the pre-approval process. Hey, looks like there's a variance in credit scores. We're fortunate enough that we can qualify, Mr. Johnson by himself, and we keep the wife off of the loan. You'll have X interest rate, Y payment. Just having a conversation. And most of the time, people are fine saying, "Hey, I'll take the ownership position. I'll be on title. You could take the liability of the mortgage." So, husband, everybody could be on title, as long as one of the borrowers can qualify on his own or her own. You could eliminate the other one just to get yourself better terms, better pricing, and and so on and so forth. So
Should we
if
move
we
on
go,
to the next slide?
yeah, let's go to the next slide because this is also really important. I have some comments here too, right? Credit history and credit score. So let's take a couple minutes and look at, what constitutes a credit score. There's a lot of misnomers here, but I just want to kind of address with this one slide. So if you guys look at this slide, you could see the biggest impact to one's credit score is payment history. Are you making payments on time? Do you have any lates? That's going to have the biggest impact on your credit score. The second piece you could see is the amounts owed. So if you have credit cards that the balances are to the credit limit, that's going to impact your credit score. So those two alone, those two pieces of the pie make up 65% of your overall score. That's a big percentage. So just simply paying on time and not maxing out your credit cards can improve your credit rating. The one thing I could help with, and I consult customers when we will go through the pre-approval process, is I kind of take a look at, hey, are these, can we improve the credit score? Is there a way to increase the credit? Can we pay down some credit cards? And if there is, it's a conversation that we have. Typically, you want to keep the balances at about 20 to 25% of the available credit limit. You don't want to pay everything off and close it. You still want to have accounts open and revolving, but just keep the balances. If you could keep it below 20%, that's going to give you the best bang for your buck, so to speak. Let's go to the other components. Obviously, right, 10% of your overall credit score is impacted by new credit. So if the length of time an account is revolving, since it's fresh, it's going to have the least. It's going to have an impact, right? If you have accounts that are just brand new, that can impact your score. Length of credit history kind of ties in with new credit, and then the credit mix. If you have is it all revolving accounts? Is it an installment accounts? That's the other piece of the pie there. What you don't see, and this is something that comes up all the time, is inquiries, right? Credit inquiries have a very, very small impact to one's credit. So when you have a customer or a borrower say, hey, I don't want to have my credit pulled because I don't want to lower my credit score. Well, this slide just shows you point blank. 65% of your overall credit score is just paying on time and not having accounts maxed out. So don't worry about having your credit checked, especially with a mortgage broker or mortgage company or a bank. It's not going to have a big impact to your score. If we go to the next slide, this kind of talks about, again, what credit history and score and what could hurt your credit, right? And we talked about this in the previous slide. Not paying your bills on time, opening too many accounts, signing up for new cards, maxing out your credit cards. All of these can hurt your credit score. So this was pretty simple. We can go to the next slide if there's any questions on this one.
I do have one question related to this. If someone's got a business credit card, does that also go on their personal credit or no?
It does not show up, no.
Okay, all right, good to
know. The next slide gets into third factor, income and debts, right? And again, we talked about this briefly, so we'll kind of we'll kind of skim through this, and I'll stop on one of the one or two of the bullet points here. So obviously, base salary, that's income that's verified. The self-employment commission and bonuses, we talked about this again. Remember, it's a 2-year average. If there's a decline year over year, so if 2021 was less than 2020, a lender is going to be more conservative and take a 12-month average versus a 2-year average. I'm going to skip over child support real quick because I want to take a couple minutes on that. Interest, dividend income, we talked about that. Again, Social Security, any permanent disability, that's income that could be used to qualify. With regards to child support, if you are receiving any child support, we have to demonstrate receipt over the last 12 months, and then continuance for at least the 3 years. So if you have a child who's, let's say, 16 years old, right,
Yeah.
you're getting X amount of dollars for as far as income or support. Since that child turns 18 in 2 years, that income doesn't come in to play when you qualify.
Oh, okay. But only 3 years out. That's surprising.
Yeah. So debts, obviously these all will show up on a credit report, right? Any auto loans, installment loans, student loans, all of this is credit card payments, again, child support payments. If somebody's divorced, we ask for the divorce decree to figure out if there are any payments or child support payments, because that's taken into consideration when we qualify you. Mortgage payments, if you have a vacation home. There's some instances where borrowers co-sign on stuff for family members. Just understand that those payments are taken into consideration when they qualify you. So if I've co-signed for my son and he's buying a car and I'm helping him with that, if whatever that car payment is, will be something that I would have to kind of take into consideration when doing the income calculation and the debt to income calculation. The only time you could this is an exception, if to omit an auto payment or any of these installment payments that are on this sheet, is if you could demonstrate that the person that you co-signed for, that individual has made the payments on these liabilities over the last 12 months from an account that's in his or her name. That way, it's an exception to the rule, but you could exclude that payment to help you qualify.
Okay. I got an extreme example about the student loan part. A few years ago, during when the housing market was really, really hot and there was multiple offers, we had a client that had a $5 student loan balance that he was not aware of that went to collections, and
Yep.
it affected his credit score, and the bank did not lend him, and he lost the house he was trying to buy for, it was like $5. It was really, really extreme example, and it was unfortunate for him. And he didn't know that he had that small outstanding balance left over. He thought he paid it all off.
Yeah, that's why it's important to kind of go through this pre-approval review process early in the game, so that if there are any hurdles, we address them head on, so that you're not disappointed after the fact.
Yeah. Next slide.
Yep. Let's talk about assets, right? Types of assets. So obviously checking, savings, anything that's liquid, money market accounts, those are all acceptable sources of monies towards a down payment. Business accounts, in some instances, you can use towards a down payment or closing costs. Stocks, bonds could be used to towards the down payment and or reserves. Any IRAs, anything like that can be as well. Just note that if you are using any of these accounts, proof of liquidation, proof of sale of the stocks are necessary. Just paper trail where the money's coming from, which accounts were liquidated. So those are acceptable sources. Everything on this list, acceptable sources of monies towards a down payment. Gift money, we talked about that a little bit. Gift funds can be used towards the down payment and closing costs on when it comes to purchasing a property. Gift funds are only to be used, are allowed when you're acquiring your primary residence. Let me talk about that just real quick. Gift funds cannot be used when you're purchasing a investment property, so non-owner occupied. Yeah, gift funds cannot be used towards that.
Okay, it's good to know. Next slide.
We should do that. Yep. So this was the last factor, right, of the process here, is the home qualification, the appraisal, the market evaluation of of a property. So let me give you an example. So if you're buying a 500,000, you're under contract to buy a home for $500,000, the bank does an independent appraisal, and the home, let's say, appraises for less than 500. Let's say it appraises for 490. Understand that the lender will only lend whatever the maximum limits are. Let's say in this scenario, the borrower's putting out 20%. So the lender will only lend 80% of the lesser of the agreed upon purchase price or appraised value. So if that home is appraises for less than what you're under contract for, the loan's going to be based upon the lower appraised value. So you'd have to come in with more money to just keep the terms of the loan the same. If in some instances, you'll have a property appraised for more than what you're under contract for. So let's say that in the same scenario, appraises for 510, the loan is still based on, means you got a really good deal, you got a good agent that negotiated for you, but the loan's based on, again, the lesser of the agreed upon purchase price or the appraised value.
I've got a question with the home inspection. Usually when you buy a home, you get all these home inspections, and they're super lengthy. It's essentially a laundry list of everything that's wrong with the house. Does the lender look at that and say, well, the chimney is bad, you have to fix the chimney, or the roof is bad, you got to fix the roof? Does the lender say that at all or not?
Good question. The home inspection is a report that the lender does not see, or they do not require it. Yeah.
Okay.
So we don't get our eyeballs on that.
Yeah, because it's usually like a scary report when you get that. It's this huge list of all the things that are wrong with the house, and you use that as kind of leverage to bring down the price of the house with the seller. So
yeah, the only thing an appraiser will point out, Ada, is or make note of, is if he, and I've seen this before on appraisal reports, is anything that he could visually see. Let's say there's he's walking through the house and the floor is uneven. He could say, hey, this get a foundation guy to take a look at this, or he'll call it out on the appraisal report. Or if he sees any wet spots on a ceiling, if he's very picky, he could say, hey, let's get a mold guy out here before I sign off on the appraisal, make sure that there's no mold. So if there's something like blatant where the appraiser see it, he'll call it out, but a lender doesn't get a copy of the inspection. It's not required.
Okay. All right. Let's next slide.
Yes, sir. So this one, we're going to talk about types of loans. You either have fixed rate mortgages and adjustable rate mortgages, which are really popular these days. So let me just touch on this a little bit, right? A fixed rate mortgage are available in various terms. The interest rate will remain fixed for the life of the loan, and you're basically making a principal and interest payment. So fixed rate loans could be as short as 10 years and as long as 30 years. So you'll have either 120 months to pay off the loan, all the way to 360 months. So depending on the customer's goals, needs, the conversations had on whether a 15-year fix is better than a 30-year, but those are the different time periods: 10 years, 15 years, 20 years, and 30 years as far as a fixed rate mortgage goes. The adjustable rate mortgages work a little differently. So these loans are typically, again, amortized over 30 years. So it's a 30-year term, but you'll have loans that are, an adjustable rate mortgage that's fixed for 5 years, 7 years, 10 years. So you'll have a rate that's good for either 60 months, 84 months, 120 months of that 30-year term, at which time, if you keep the loan past that fixed rate period, you can or may see fluctuations in your interest rate and your payment. But if you have a customer who, hey, I'm not going to live in this house for more than, this is a 5 or 7 year investment for me. I'm probably moving. There might be a job change down the road. He's on a 5-year contract. Why get into a 30-year fix if you're going to sell this property or move on from this property in 5 to 7 years? Adjustable rate mortgages in this climate have lower interest rates than fixed rate loans currently. So most people that are purchasing now are taking advantage of these lower rates, lower fixed rates. They're called ARMs, right? Adjustable rate mortgages. They'll have a rate that's fixed for 7 years, 10 years, and gives them the opportunity to revisit the loan, whether to refinance or sell or what have you. But interest rates today on adjustable rate loans are a little lower than fixed rate mortgages.
Oh, interesting. Okay. Should we move on to the next slide?
Let's do that. So this continuing on this, topic of types of loans, you have government loans, you have conventional loans. There's obviously a difference. FHA is a acronym that's thrown around a lot. So it's the Federal Housing Administration. This is a government insured mortgage. You also have VA loans. So if you're a veteran, you can take advantage of the VA benefits and entitlement. Different criteria we won't get into because it's really detailed, but it's just mortgages that are insured by the government against loss. So if the person was to just refrain from making the mortgage payment and the property would go into default and foreclosure, these loans are insured by the government against loss to the institution that has lent the money. Conventional mortgages, so you've heard Fannie Mae, Freddie Mac. Those are the two mortgage giants that securitize these loans and back these loans. Conventional mortgages, they tend to be tougher for borrowers to qualify, but meaning the criteria, underwriting criteria are a little different, but the costs are much less than government loans. Mortgage insurance premiums on FHA mortgages are much higher than conventional loans, and the reason for that is obviously, as I mentioned, these government loans are provide protection to the institution against loss. So if you were to miss or go into default, it's securitized by these mortgage insurance premiums. So it's less costly on the conventional side than the government side.
Okay, okay, makes sense. Should we move on next slide?
Let's do that. So we'll just touch on some things to avoid when you're in this process of qualifying. Changing jobs. You don't want to change jobs because it's going from one employee, especially in the middle of the transaction. If you're going to be making have that conversation. I've had that happen a couple times where we'll be at the end of the deal and we're trying to verify employment prior to closing, and the employer says, well, the borrower's no longer here, and you have to make that phone call and find out, oh yeah, I had a raise and I moved to this other company. So try to avoid any employment changes during the middle of the transaction. Avoid any financing or major purchases, right? So you'll have customers who are, hey, we're almost to the end here. We're closing in a week or so, and let's go ahead and go get that refrigerator, or let's get the dining room table. There's a sale this weekend, and they'll go and apply and take on new debt. Most homeowners or home buyers don't know that your credit report is being monitored by the lender during that time that you're in escrow. So anytime you have a new inquiry, anything like that, the lender gets notification. Hey, why don't you go ask Mr. Johnson what that inquiry was, yesterday or the day prior. It looks like he might have acquired new debt. So if you're really tight on qualifying and you buy a refrigerator that has a monthly payment of $100 or $200 a month, understand that minimum payment can impact or affect your ability to close the transaction.
I didn't realize the lender actually tracks your credit score during the transaction.
They do. They monitor the credit to make sure that you're not getting it pulled, you're not acquiring new debt. That's going to impact the saleability or the closing of that loan.
Interesting. Okay.
Yeah. Next slide. Again, this kind of talks about, again, we just mentioned it, right? Having your credit pulled. Um, don't have your credit pulled during the transaction. Switching banks or moving money between accounts. So if we're presenting a lender with, let's say, your Bank of America and your Chase checking account statements. If you're moving money from an account that's not on my application, and that money's coming in and out of an account that's already verified and vetted by the bank underwriter, they're going to want to know where those other funds came from, and it just opens up another Pandora's box of questions and conditions that you don't want to deal with during the transaction. So if you're going to move any money around, it's best to have a conversation with your loan officer just to kind of give them the lay of the land so that it doesn't hold things up down the road.
Or just hold on until after the deal closes and do it then.
Agreed. Yeah. So again, these are obviously, I'm just going to read through them, but obviously we touched on these, right? Taking on additional debt on your existing credit cards or lines of credit, all debts must be disclosed. So if you have an account that doesn't have a balance on it, and all of a sudden you start, again, making purchases, premature purchases prior to the close of escrow, that could add additional debt, additional payment to the calculation, and it can impact your ability to close. Don't co-sign for anyone or anything during the transaction. Wait until the deal closes if you want to help out a family member or whatnot. Do it after the fact. And then this last one, starting any home improvements that are not a condition of the loan. Anything, if a property is going through construction, if a lender does a final inspection of the property for any reason, if they see any improvements going on, it could hinder the timeline and the close as well. So you want to avoid some of these things.
Okay. Should we next slide?
Let's do that. We'll take a couple minutes, and this is probably the bread and butter of the presentation as far as qualification, especially for self-employed borrowers. Obviously, the after 2008, 2009, the terminology QM, non-QM. So QM stands for a qualified mortgage, and this is basically, centers around a person's ability to repay the loan. That's where the tax returns come in. That's where the pay stubs come in. That's where all of this, documentation and sourcing of funds comes in. So this definition of what a qualified mortgage. Obviously, this is right around the Dodd-Frank Act. So borrowers must have a reasonable debt-to-income ratio, and mortgage lenders can offer mortgage products with artificially low introductory monthly payments that sharply increase when the teaser period ends. So again, this goes back to when they were writing, banks were writing loans that were, had an introductory rate for the first 12 months, and then the rate just skyrocketed after the fact. So a lot of the changes came in as a result of the mortgage meltdown. So the non-qualified mortgages, they don't conform to the consumer protection provisions of the Dodd-Frank Act. So these types of mortgages fall outside those criterias. The non-QM mortgages, again, are again, like it says, applicants whose incomes vary month to month. So inconsistency of pay, right? We talked about that in the previous slides. They may have some unique circumstances, have a lot of write-offs on tax returns, don't show their true income on they just started a business or had a business going for a couple of years, and the income's just not there because of, for whatever reason, it's not reported on the tax return. That's typically the difference between a qualified mortgage and a non-QM and a QM loan.
What's the typical, I'm sure there's no typical one, but the spread between a non-qualified and a qualified mortgage interest rate. So if a qualified mortgage rate's 5%, is like a non-qualified maybe 6% or 7%? Like what would be the typical spread between the two?
Yeah, if all things are equal, right? Credit scores, type of transaction, type of down payment. I'd
Right.
say, yeah, I would say, currently you'll have a 30-year fixed. Let's say it's in the somewhere in the mid sixes. A non-QM loan would probably be somewhere in the mid sevens, I would say.
Okay,
Mid,
so like a 100 basis point difference, probably.
yeah.
Okay, all right. Next slide.
Yes. So this talks about who can benefit from these types of loans, right? Non-qualified mortgages. So anybody that's really self-employed, that may not show their true income on a tax return. Any business owners, again, who file returns that are, have expenses or write-offs that don't show their true bottom line income. Those with high levels of debt. So the debt to income ratios on these loans are typically higher than the conventional QM qualified mortgage loans. Have lower credit score requirements. So if you don't have the most perfect credit, and have these other components in play, this might be a good option for you. Again, just anybody has inconsistent income or unique income, real investors or freelance people that don't have consistent pay. Again, the big takeaway from our conversation here today obviously is ability to repay, right?
Right.
To through a QM, a qualified loan, 2 years of returns, 2 years of W-2s, pay stubs, everything's scrutinized. When it comes to non-QM, things are a little different, qualifications a little different. If we go to the next slide, you could see kind of some of the benefits and some of the documentation, because it's a little different than what we discussed earlier, right? So you could see there's the ability to qualify. There's mortgages in place that'll this is for self-employed borrowers, right? It's basically a bank statement qualification. So if you're self-employed, again, there's programs can vary. It's either a 12-month bank statement program or a 24-month bank statement program, meaning instead of tax returns to validate your income, for this particular product, you will have the borrower shows the lender either a personal or a business bank statement covering a 12 or 24-month period, and the lender will take a look at the deposits that are going into these accounts, right? And they'll do a 12-month average or a 24-month average, depending on the program that you're going with, and they'll take a percentage of that average, depending on, again, the type of business that you own. Is it a service-based business? Is it like a product-based business? The number of employees. There's certain there's certain criteria, but in most cases, you could use anywhere between I think it's like 85% or all the way to like 75 to 85% of those deposits as income on your loan application.
Wow.
Again, if it could vary if it's going into a business account or a checking account, but the program does exist. So you could see that, the last bulletin point, like you don't need to provide a lender with tax returns or W-2s to validate that income that you've listed on the application, because it's a bank statement program. You're self-employed. These are your earnings, and they take a percentage of it, and it does not need to be validated with a tax return. So
are these harder to qualify for that reason, or no?
They're not harder to qualify for, Ada. It's just you have to have
The income, sure.
you have to have the trail, right? You have to have the app, you have to have the deposits, you have to have a legitimate business. Somebody that's, salaried can't use this program.
Right.
Like, somebody that's just getting into the business, has been in the business 6 months or 12 months, can't use this program because you need a 2-year history of being self-employed.
What if you're self-employed, but you also get a W-2 from your corporation? Like, how does that work?
So you can't commingle. This is specifically a bank statement program. So we can't do a bank statement program and then on top of that introduce salary. So it's
Oh,
like
I see.
one.
So you're only looking at the bank money coming into the business bank account, not the personal bank account.
Correct. Well, you can go into the personal account too. So it's just it's got to have, but that's where the business license comes in, right? So if it's going into your personal account, you could validate that you're the owner of this business. If the
Right.
money transferred and you could document the paper trail, it could go into your personal account.
Okay.
But you can see the debt income ratios on these loans are much higher, 40 up to like 49%. So
Yeah.
typical DTI in the QM world is 43.
Okay. So yeah, you
So
can go significantly higher.
yeah, profit and loss statements are needed in lieu of tax returns or K1s. So the paperwork's the financials or the documentation's not as extensive as the qualified mortgage route, where you're looking at 2 years of tax returns, you're looking at W-2s, you're looking at pay stubs. In this particular instance, with this particular program, you're doing a 12-month average of deposits going into a bank account if you're self-employed, and an average is taken to use to qualify. So
Okay.
much simpler.
Yeah, I think a lot of people, at least in our clients, would fall into this category, which is why I was so interested in kind of hearing this part as well.
Yep.
So, well, I think that's almost the last slide. So, Bahar, thank you very much for doing this. This is extremely helpful and educational. I'm going to put your information in the comment section below. So if people want to get in touch with you, they can do that. And then obviously, if they want to reach out to me, I can connect them with you as well. So thank you again for your time. Really appreciate it.
Yeah. Thanks for having me.